Perfect. Good evening, everyone, and welcome. Today, Mike and I are going to talk about the advantages of uh, various tax saving strategies as real estate investors.
Hi everyone, welcome to the webinar.
The usual disclaimer, obviously, this is for educational purposes only. We're not providing or selling any securities. This is strictly for information and education purposes. And I'll give you guys a couple of seconds to go through this.
Yeah, we're not offering any advice either. If you're interested in any of our funds, please request the PPM. That's the formal offering document.
So these are, before we go into the strategies, what I want to point out to you is that there is a big difference between a tax strategist and a tax compliance officer. So, and the main difference, typically when people need to file tax return, they hire a CPA or accountant that is simply following the compliance and filing their tax return. So this would be simply a tax compliance accountant. If you're looking for someone who can give you further guidance, I highly encourage you to find a tax strategist. And in some cases, it could be the same person or the same team if they have multiple people working on a team. But in a lot of cases, there are people that specifically concentrate on providing tax strategies. So they give in guidance, they help and work with you on your particular case on providing guidance into the future as to how you can plan your future. And I have an example, one such investor of mine who has been with their CPA for about 10 years, after working with the CPA for 10 years, when they had and hired a tax strategist, and they were able to save at least $7,000 in taxes because they hired the tax strategist. So I always encourage people to be on the lookout and hire a tax strategist if you're looking for ways to save on taxes down the road. These are the 5 strategies that Mike and I are going to cover today. This is not to say that these are the only 5 that are out there. There are obviously plenty more, but we just want to concentrate on these 5 and share with you the knowledge that we have as to how these 5 strategies work in general. So the first tax strategy is obviously using depreciation. And in the case of depreciation, there is also a way to increase that depreciation by hiring the engineers to perform the cost segregation study. The main difference between doing the regular depreciation and performing cost seg is that if someone is buying the property, and let's say residential, the depreciation is 27.5 years, and for commercial property, the depreciation is 39 years. If you were to hire a cost segregation expert, they can help you pull a lot of the deductions much sooner and in this way accelerate the depreciation and take the deduction, a much higher deduction upfront. And so in general, as an example, there are plenty of parts of the commercial property that can be accelerated, for which depreciation can be accelerated, and it can be allocated to 5, 7, or even 15 years. Also, bonus depreciation is also available through the Tax Cuts and Jobs Act, and it can enhance your ability to recover the cost sooner by using the cost depreciation study. And while bonus depreciation was enacted through this Tax Cuts and Jobs Act, it has also enhanced the benefits of depreciation in general. So let's do this. Let's look at a specific example to see how can the depreciation be accelerated. So let's say we purchased an apartment complex, $200. The purchase price for it was $10 million. we raised roughly 3.5 million of equity. The cost segregation study resulted in depreciation to be 3.2 million. And the earnings for this property, the income for the year one, prior to depreciation, were 100,000. If we do the calculations for the net operating income, so we would have to take the total income, which is 100,000 for the year, and subtract the accelerated depreciation of 3.2 million. That would bring our net operating income to 3.1 million negative. So it's 3.1 million loss. And so this 3.1 million would be distributed among all of the investors, among all of the limited partners who contributed towards the 3.5 million of the equity. And just to give you an example, for someone who hypothetically contributed 100,000 to this project, this would result in 88,500 of loss in year one. This is significant, and that loss can be carried forward, of course, if you're not able to use it in year one.
Let me just one quick comment. So in this case, folks are getting 88.5 cents per dollar invested in the first year, which is pretty good. With some more advanced strategies, it is possible to get that ratio to be higher than that. We've done deals where the ratio is actually over 3. So the crazy part is that if you can get the ratio up, to 2.5 to 3 times, so for every 100,000 invested, you can get $300,000 of loss. And you obviously need to have the debt basis for this. One of the key requirements, it has to be qualified or non-qualified, or it has to be qualified non-recourse debt or recourse debt to be able to go above dollar for a dollar. But it is possible to get depreciation to be so substantial that you get deduction, for example, 250,000 per 100,000 invested. And if you have gains that you need to offset, this can basically turn into tax loss harvesting. Essentially, you can get a gain from a sale and a loss from a depreciation of a new investment and generate very substantial savings. Anyway, forgive me for interruption. I'll let you continue.
No, it's all good. Thank you, Mike. So in general, the point that Mike and I are trying to bring across, that number is not set in stone. It's not always 88,500 for every 100,000. It could be less, but it could be a lot more. But in general, there is a huge potential of generating this accelerated depreciation and taking advantage of the losses that you may or may not be able to take in year one, but you can always carry them forward and offset in the future. The next tax saving strategy is to utilize the advantages of becoming a real estate professional status. Who is it most common among? It's very common among developers, various investor buyers, flippers, real estate brokers, real estate agents, operators, leasing agents, property managers. The general rule of thumb is to be a real estate professional, you need to obtain at least 750 hours working in real estate field. And ideally, you should not have another full-time job. So if, let's say, your full-time job is a real estate agent, then that would bring you on the real estate side. But any other full-time job, if, let's say, you're a doctor, then that would make it a lot harder to qualify to become a real estate professional. So if you have a part-time job or no job at all, it's a lot easier to obtain these hours, 750 hours. And to qualify as a real estate professional. So that could be a great consideration for a couple where maybe one spouse has a full-time job and the other spouse does not have a full-time job. So they might be able to obtain a real estate license and then work within real estate field to obtain the much needed 750 hours. What does it do? It allows you to take advantage of these losses a lot faster. If you're still a passive investor and not qualify as a real estate professional, then as mentioned earlier, you take these losses and you carry them forward, and then you net them against passive gains that you will obtain down the road.
A couple of quick comments. If you could go back for a second to the slide.
Sure.
So obviously consult with your CPA. This is not a trivial checkbox. So you need to meet multiple requirements. 750 hours, as Alina mentioned, also has to be a primary activity. And then you have to spend those hours performing sort of these qualified duties or services that would put you in a position where you could be considered a real estate professional. But you also have to do some other things with your tax CPA. There's an election called 467C7, and consult with your CPA if it makes sense. If you decide to proceed this way, take this journey very seriously, because it can provide very substantial tax savings. At the same time, you need to have pretty strict compliance. And one of the most important things, track the hours in Excel spreadsheet and what activities you're doing. So just a little bit more color. But if you're successful executing it, you could use the depreciation losses to offset current income. Again, one spouse is a real estate professional, the other spouse could be a very successful doctor with a high income. So this strategy has been used in the past, and it can be a tax saving tool.
Yeah, I think, Mike, you jumping ahead a little. This is the slide we have next.
Oh.
Essentially, let's talk about what you just covered. So thank you for covering that. We're using a doctor example where a doctor potentially making $1 million in income, and she or he has a spouse who is not working, so they're able to obtain the real estate professional status and, let's say, receive $800,000 in losses. Because they have the real estate professional status, they're able to offset their taxable income against these losses, and then essentially make the net income to be $200,000. Again, these are just examples to show you what can potentially be done with the real estate professional status, but always consult with your CPA in cases like this. The next strategy that we're going to cover is essentially capital gains that are produced in real estate. One of the more common questions that I get asked are your funds essentially REITs, and I tell people, no, our fund is a real estate fund. It's not a REIT. And REIT stands for Real Estate Investment Trust, which in general terms is sort of like a real estate mutual fund. You can look at it that way. In the past, these funds have always been taxed at your ordinary W-2 rate. As a part of Tax Cuts and Jobs Act, that has changed slightly, as you can see, and so there are new rates based on your tax bracket. The rates, and you get a 20% deduction as a qualified business income, and that deduction brings you into this new bracket. And even though this bracket is lower, it is still higher than the real estate capital gains brackets, which are 15 to 20% range. So it is still a lot more beneficial to obtain real estate gains and losses as opposed to invest in a REIT, which again puts your income that you receive from your investment into much higher rate.
Yeah, thank you, Alina. The other quick difference between our funds and REITs is that strategy-wise, REITs typically invest in performing assets focused on yield generation. And our strategy in most of what we invest in focuses on the value add. So the way to think about this, we can invest in a project that goes through value add and then completes that and becomes fully stabilized, and it becomes a sale point into a REIT's entry point. So one example would be self-storage facility, where there is a value add to take it from from an old Macy's to redevelop into self-storage, and then it gets sold to a REIT that acquires it for income purposes. So it's a very different part of strategy. So we're sort of focused on a different part of the market, and obviously REITs taxation is different from from us. And here you could see an example how a REIT could actually be taxed substantially higher than capital gains taxes.
Thank you, Mike. Yeah, I mean, there are a lot more differences between REITs and real estate investment trusts, and we can talk about the fees and the structures and the investments overall. But since we are concentrating on taxes, let's move on to the strategy number 4. And Michael, I'll let you take over.
Sure. So one of the primary benefits of real estate investing, and most of the wealth has been built on appreciation. People invest for cash flow, and it is absolutely great. And depending on where you're at, there are markets where there is no cash flow. If you go in the coastal markets, big cities, most people invest purely for growth. And that strategy has worked for many years, but while the growth is a function of the market conditions, what we are talking about, you have two ways to essentially benefit from appreciation. One is a natural appreciation when all prices rise in a given city or town. And two, what we call it forced appreciation. So forced appreciation is typically triggered by value-add investing. So there are many, many examples. One I just mentioned previously could be a value-add project converting an old retail, big box retailer like Macy's into a self-storage facility. Or there could be value-add taking somewhat aged, outdated apartment complex and taking it through external renovations, internal renovations, improving roofs, sidings, and then apartments inside the apartments, new appliances, new flooring, obviously fresh carpet and paint, and increasing rents as a result of the work of the operator of that strategy. There are multiple other strategies. Some of the most recent strategies has been we've been investing in. It's been a very hot trend in the, let's just call it, pandemic environment. It's conversion of hotels to multifamily housing, as many hotels are dysfunctional and some of them didn't work well before COVID, and the COVID kind of knocked them out. And then the highest and best use has become to use them as affordable multifamily housing. So all those value-add strategies. Another recent strategy we've seen, office conversion to multifamily. There appears to be a lot more demand for housing and a lot less demand for retail space, office, and so on, and hotels, obviously. So these type of value-add projects could create what is known as a forced appreciation. And typically, forced appreciation comes as a result of increase in net operating income, sometimes lowering expenses. And again, most of commercial properties trade as a multiple of NOI, net operating income. They trade on a cap rate. So if NOI is $600,000 a year and the cap rate in that area for that type of asset is 6%, you simply divide the NOI by the cap rate and you wind up with the market value of $10 million. So again, as NOI increases, the price of the asset increases as well, but it's magnified by the cap rate. The lower the cap rate, the greater the magnification. And again, it could be development, redevelopment, set of capital improvements, operating improvements. All those things can impact the cash flow or the NOI of a property, and as a result, accelerate or improve the value of the property. So what happens, what's really interesting in today's environment where the markets appear to be hot all over the United States. So some of the projects, they benefit from both. There's a value-add strategy that lifts the value of the investment. So here's an example. So let's just say it's an investment in a hotel conversion to multifamily. An all-in cost is $6 million. And upon completion, the projected future value of that apartment complex is $8 million. So the forced appreciation has created $2 million worth of sweat equity, let's just call it, generated by the operator or the sponsor. Now, if the market has also picked up, that 8 could become $9 million in the value simply because of general appreciation in the market. So the risk of general appreciation in the market, if the market cools down, there could be a negative general appreciation. But the forced appreciation creates that upkick regardless of what happens in the market. But there are risks associated with value add. The execution has to be on the budget, on time, on quality. So if those elements of the strategy succeed, then the overall value creation is very substantial. So investing in value add does require investing with very, very competent an operator, because the key to the success is the strategy execution. So the next one is good old conversion of traditional IRA to Roth, and this is a pretty cool concept. It's been around for a long time. So you can convert in cash, or you can convert through an investment into a syndication or a fund, or any property that you could own the property outright. It could be one investor, one property. It could be a partnership, a syndication, or a fund. So the strategy is pretty powerful from the point of view that it allows investors to convert at a value lower than the cash they invested in the property. And how can that be? Well, think of it very simply. You bought a house and you just demolished the house to build a new one. The value has dropped. Typically, the value of a house is greater than the value of pure land with nothing on it. So the demolition actually lowers the value. The same could be true with a number of these redevelopment projects. If you have taken a functional hotel and you're redeveloping into a multifamily, you do a lot of construction and demolition and heavy heavy work that initially you've stopped the functional hotel, you kill the revenue stream. You're no longer getting the hotel revenues. You have mortgage expenses, you have a number of other expenses. So the value of the asset initially drops, and the uplift of that value is a function of a successful execution of the value strategy. But you, as an investor, if you wrote a check in the deal and you choose to convert at a time when the deal or a fund reaches sort of a low point, if you time it right and you can get a qualifying CPA or appraiser to write you a letter, you can actually convert at a valuation substantially lower than the cash you invested. So the strategy is very powerful that if you convert in cash, you pay the taxes on the dollar that you invested. But if you convert through an investment, you have the opportunity to time it right and to get the right documentation to be able to convert and save a lot of money. So for example, you wrote a check $100,000 into a deal, and say 2 years later, the deal has substantial, it's in the middle of a value add strategy, and it could be worth $70,000, $60,000. So you can convert based on a lower dollar value and pay taxes on the conversion amount. Again, if you converted cash, you have to pay taxes on the $100,000 that you converted. If you convert in a form of a investment, you may be paying taxes on the value of $60,000. Again, consult your CPA, but the strategy is generally very solid. It does need justification. Your IRA custodian is not in the business of appraisal of these properties. If you can document a lower value and bring an appraisal together to the IRA custodian, they'll most likely review it and will accept it and allow you to convert at a value lower than the cash you invested. So the other interesting term is value add projects returns often look like a J curve, like a letter J. What does that mean? It means that in the initial quarters and years, the value of the investment can drop when they're executing substantial value, and at some point reaches the bottom of the J curve, and then things start picking up. And on the back end, it accelerates when the property is fully stabilized and is sold. So that's the basic theory. So returns could look like a letter J. If you can convert at the bottom of the J curve, you've timed the market to be so almost perfect to convert to the lowest valuation.
Thank you, Mike. These are some of the filing requirements. So Mike was talking about the self-directed and solo 401k accounts. Each of them has their own tax filing requirements. And notice how there is a threshold for each type of account, whether you have a checkbook IRA or self-directed IRA with custodian or solo 401k. There are various forms that need to be completed, but that should always be done by your tax accountant or CPA. So have them look into the thresholds and provide them with the tax forms that you are receiving from your investment, and they should be able to help you with that. One point to keep in mind is that there is a potential of being hit by the UBIT, which is unrelated business income tax. That income tax, while it's generated, may be generated due to the unrelated debt-financed income, it typically applies to either self-directed IRA with custodian or checkbook IRA. It does not apply to solo 401k, as there is an exemption for solo 401k from UBIT in general.
Yeah, Alina, great comments here. Just a one quick further comment. So UBTI or UDFI, they feared. A lot of investors are concerned whether they have to pay it or not. And here are the technical requirements. If you have taxable income over $1,000 a year, in theory, it's subject to the UBIT. The UBIT or UDFI, to be more exact on leverage deals, it can arise from the leverage on the deals if you invest in a syndication from the IRA and you are part of the equity investment. UDFI could be due, but quite often depreciation will offset that for a substantial amount of time, and the tax may be due on sale when the asset at that point is liquidated. So the previous slide about conversion of traditional to Roth is independent of this. Whether you're in traditional or you're in the Roth, if UBIT is due, it's due. And at least the strength of solo 401k is that the UBIT or UDFI is not applicable due to the leverage. But the both taxes are applicable if you decide to buy, a McDonald's and operating a business in your IRA. UBIT still applies. There are two primary use cases, but for most people, they're not buying McDonald's. They invest passively, and they just have to worry about the UBIT or UDFI related to the leverage. So consult with your CPA, and there's one interesting strategy to deal with this UBIT. If you are 100% sure you have to pay UBIT, you may want to consider setting up what is known as a blocker C Corp. It's an advanced strategy. Some folks have utilized it when they were highly confident UBIT was due, and they just wanted to make sure that they pay corporate taxes rather than the UBIT tax. UBIT is taxed at a pretty high rate. That's why that blocker C Corp idea could be applicable. But in this case, don't overthink it. Consult with your CPA, but the risk of a UBIT is pretty low. Sorry, the risk of the UBIT audit, or IRA accounts don't get audited, and a lot of people wind up not filing UBIT and not realizing the UBIT is due. So not advising you not to file, but just making a comment that a lot of people fear UBIT as if this is going to happen tomorrow. So just be mindful, speak with your CPA. The risk of an audit of an IRA account is extremely low.
Yeah, thank you, Mike. And what I want to add to that, what Mike mentioned in terms of the gains that may potentially be generated at the end of the life cycle of a project. So when you have the gains, you also most likely, if you're not claiming real estate professional status, you have losses that have been carried forward. So first you go through the process of offsetting these losses against your gains. Then the only portion that may be qualified to be taxed for UBIT unrelated business income tax is the portion that is what's the right word? Is the ratio of your investment and overall investment versus the loan of the investment. So if there was a loan on the investment, then that percentage would be applicable to how much you have invested. And then only that small fraction would be responsible for the unrelated business income tax.
Yeah, Alina, the term you were missing, you were trying to say, is to the degree of leverage. So UBIT is only due to the degree of leverage. If the leverage is 75%, it's due on 75% of income. If leverage is 60%, it's due on the 60%. So
I was trying to use the simple terms, but thank you, Mike.
No, sure.
And now, Mike, let's go quickly through the Tempo Growth Fund.
Sure. Thank you, Alina. So Tempo Growth Fund is a closed-ended fund. This fund can substantially help with some of these strategies. This fund has a number of benefits that could be considered for different type of strategies. So number one, the fund passes through a good amount of passive losses and depreciation. Because this is a growth fund, a lot of projects we invest in are not income projects. So we invest in a bunch of hotel conversions to multifamily. We have investments in office conversion also to multifamily, a number of self-storage projects. So all of them in their nature generate all kinds of passive losses driven by operating losses of the projects while they empty while they're going through the conversion, and then also through the depreciation. Some investments we have in value-add multifamily that have a segregation studies. One project that I mentioned, the fund is in, is given us last year 3x ratio for every dollar invested because the project had very substantial leverage. So passive losses can help offset number of passive gains if you're not a real estate professional. Specifically, number of folks have asked, can I 1031 into the fund? And the answer is you cannot. However, you could use passive loss harvesting. You could sell an appreciated property outright, get your sort of capital gains. At the same time, you invest in the same tax year, and you use the passive losses from Tempo Growth Fund to offset passive gains generated from the sale of another real estate property. I just like the term. It's called pigs versus pulse. So passive investment gains, pigs need the pulse, passive allocation losses. So if you have the gains by investing in the fund, you could essentially harvest the losses to reduce your tax liability. Another example where the fund could be used is if you want to convert traditional to Roth at the bottom of the J curve, like we talked earlier. The fund passes through initial substantially losses, and at some point it'll hit the bottom of the J curve, and then the gains will start picking up, and that's maybe a good time to convert. So again, this fund could be used as a vehicle to execute some of these strategies. But the fund itself is well-diversified fund. It targets annualized return to investors after all fees, on average, 12 to 18%. Please be very clear on this. This fund is a growth fund. It doesn't distribute 12 to 18% every year. The way to think about it is you invest the money. It's a 5 to 7 year horizon. You write $100,000 now, and 5 years later, you get $175,000. That's the way to think about it. It's not going to be exactly like that, but most of the growth funds operate like that. Most of the income is delayed and deferred until these projects go through value add, and cash flow does start. So in this fund, we project the cash flow will start in 2023, but until that time, the fund generates no distributable income. It's tax efficient in two ways. One is a lot of depreciation and passive losses, and two, most of the gains on the back end will come in the form of capital gain. It is IRA friendly. The fund itself uses no leverage on a fund level, and the fund pays 8% cumulative preferred return. What does that mean? It means that when we underpay, we can't pay in the early couple of years because we don't have the cash flow in the fund. The fund simply accumulates. So year one, it accumulates 8%. Next year, it accumulates another 8%. So 16% is due. And then it accumulates another 8%, 24% is due. When the cash flows start, they start catching up on the pref. So pref has to be caught up fully. Once the preferred return is fully caught up from distributions, then there is a full return of capital to investors. And after all the capital is returned to the investors, then the performance split kicks in. So for Class A units of the fund, Class A units are granted to those who invest $1 million. They receive 80% of the upside. And 8% preferred return plus that 80% capture on the Class A units or 70-30 on the Class B units. In total, they generate the 12 to 18% target. So a combination of preferred return and the performance split is what gets investors to the target return of 12 to 18%. Again, consult with your CPA, but this fund can be used in a number of the strategies. If you are a real estate professional, you could use losses from the fund potentially to offset your other income. Again, consult with your CPA.
Thank you, Mike. And this concludes our presentation for today. I hope you guys enjoy it. And definitely teach your kids about taxes. It's better to start teaching them when they're younger. All of them, you love ice cream, so that could be a good example to take a portion of their ice cream. We do welcome questions, and I see one in the chat box. Feel free to post that either in the chat or in the Q&A. So the first question that I see is the strategy number 4, which was the appreciation tax strategy, that will result in a higher income upon sale. Yes, that will result in a higher income. That's the plan, to have a gain at the end of the sale. I don't see direct impact on me, as I can't use any related expenses or losses on my personal tax return. Mike, you want to take that?
Yes. So again, if you are not a real estate professional and you get the losses and you have nothing to do with them, they just carry forward. So it's not the worst thing in the world. You wind up carrying forward passive losses, and you may have other investments in real estate that will generate passive gains, and you'll be able to use it in the future years. Or when you exit the fund, these passive losses will be deducted from the gains you're going to receive upon sale, of the assets of the fund. So the fact that you can't use them today, it doesn't really hurt you. It can only benefit if you find it the use in the future years, and there's no drawback at all to to these benefits. The other quick comment that I had, one of the most recent questions that has come up: what's going to happen when the capital gain tax rates are increased, as proposed by the current administration? And that's a great question, and it is a tough question. What's going to happen? But I can tell you this: if you're in a stock market and your stocks have appreciated, and you sell, you have no option to 1031 out of the gains. You also have no option to use passive loss, tax loss harvesting. So in other words, you sell, you have to pay the capital gain taxes at the higher rate. If you invest in real estate, one of the major benefits is that you have these strategies that can help you deal with gains even if capital gain rates are higher. So what will happen most likely is most investors, when they sell, they immediately find another deal or another fund with a lot of depreciation and losses to get those gains offset as quickly as possible in the same tax year. So what's most fascinating is increasing capital gains rates could actually cause the government to collect less revenue, because people will be motivated to find every way to defer the tax liability when the rates go up. So it's kind of counterintuitive, but historically the data proves it. So if the rates go up, then the creativity of investors goes up too, and they find ways to delaying the taxes, or they choose not to sell the asset, or sell the asset and then roll the money into the next deal with a lot of depreciation.
So essentially, most of you have heard that potentially 1031 exchange may be eliminated, but the tax loss harvesting laws are not going to be eliminated. So by selling it again and going into another project with depreciation, you will be able to take advantage of the tax loss harvesting laws. Thank you, Mike. Okay, let's see. Where to find the tax strategist? My approach is, if someone concentrates purely on tax compliance, that's probably not a tax strategist. You can ask them for recommendations. But Mike, do you have any suggestions as to how to find?
Yeah, I don't, I'm not a tax strategist. I can tell you that we have a relationship with a few folks that do some of the financial planning. They're licensed financial planners. So feel free to reach out. I have a good friend, Ryan Parson. He's been on my podcast a number of times. He does have some tax planning, and he does have some tax strategy services. You're welcome to talk to Ryan, see if it's a good match for you.
Thank you. So guys, feel free to reach out either to Mike or myself directly, and we'll connect you with Ryan. What will happen to capital gains tax with Biden reforms? well, as Mike mentioned, the capital potentially, if Biden reform is implemented, the capital gains tax may go up, but nevertheless, you can still take advantage by investing in real estate and take advantage of depreciation and the losses that are created through this depreciation and apply the tax loss harvesting. And not rely on having to pay the higher taxes, because if you have the losses through depreciation in the project and maybe another project has sold or your fund has closed, then by immediately going into another fund or into another project, you're able to generate new passive losses that you can net against your passive gains.
Yeah, exactly, Alina. Just one more comment here. So Tempo Growth Fund is a closed-ended fund. We will close the fund in January of 2022, and then we'll invest. And as the money comes back, people have asked, am I going to get taxed immediately? The fund has a lot of kind of efficiency for the first few years, and depreciation and passive losses will shield all of that. And towards the end of the fund, when the profit starts rolling in, what do you do with that if the capital gains are much higher? And it's a great question. At that point, you just got to find the next fund. We'll have Tempo Growth Fund 2 and Tempo Growth Fund 3, which in their early years, it's the same behavior happens. They have losses and a lot of accelerated depreciation. So if you want to keep kicking the tax can down the road, you'll have that option. You just roll to the next fund and you keep growing your net worth or your nest egg while you're deferring the taxes. I mean, this has been one of the major strengths of real estate, is exactly that. You can't do it with the stock market, but you can do substantial deferrals in real estate using the strategy that the new deals with ton of accelerated depreciation will offset the gains from the sale of other deals that whenever they take place.
Thank you, Mike. Guys, I don't see any more questions. Are there any other final questions that you may ask? We appreciate all the questions you're asking. Sounds like we have a really engaged audience. Thank you for all the fantastic questions you have.
Yeah, feel free to reach out to Alina and me with follow-up. Again, we're happy to do as a as a friendly conversation, no advice being offered at all. So if you do want to obtain professional advice, speak with a licensed CPA or an attorney, but we're available for a conversation under the First Amendment rights. So.
Thank you, Mike. That sounds good. Yeah, looks like we've answered all the questions. Again, thank you very much, guys. I hope this was helpful. We are recording this session, so if you want to re-listen, or for those that missed it, we will be sharing the recording with everyone who registered. And feel free to reach out to us afterwards. Thank you and have a great evening. Bye, guys.